Let's review straight line depreciation. You probably had some of this in your accounting class. I'm just going to review it. It's important when we do these capital budgeting problems because, you know, how things are depreciated affects cash flows in different ways, in the taxes that are paid, as well as at the end when you sell an asset, you have to take into account how much it's been depreciated. So we'll talk about that. So let me review some of the details of depreciation, and we'll talk about a few examples here. So I've got an example here. Your company buys a machine for $100,000. It will be depreciated straight line basis over 20-year life. And so the machine is expected to last for 20 years. It costs $100,000 now. Obviously, you're going to depreciate that $5,000 a year. Okay? So $100,000 used up over 20 years. That's using up $5,000 of the machine per year. All right, so the depreciation expense will be $5,000 per year. Now, the next question is about the book value, and you need to understand this because it's important for taxes later on when we sell an asset. The book value becomes important, so you need to realize what the book value is. And the book value is just the original cost of the machine minus all the depreciation that you've ever taken from the machine. So, for example, in our case here, where we bought a machine for $100,000, we're depreciating over 20-year life, so that's $5,000 per year. Well, then after the first year, we'll depreciate $5,000. The book value then will be $100,000 minus the $5,000 depreciation, so $95,000. Okay, at the end of the first year. Okay, and then by the same logic, at the end of the second year, well, at the end of the second year, we take another $5,000 off, and so the book value at the end of the second year will be $90,000, right? And it will continue on that way. The book value will go down $5,000 a year, and if you keep the machine for 20 years, it'll just go down $5,000 a year until it reaches zero in the 20th year. Okay. Okay, and then one other thing we can do with straight line depreciation is we can depreciate it to a salvage value, and that means we're going to depreciate this thing, over its whole life. But we think that when we get to the end, it will still have some value left. I think of it as, I can sell it off for recycling for $10,000 if it's a big heavy metal machine. Let's say, what's left, I can't use it for its original purpose anymore, but when I get rid of it, it'll still have some value there. So instead of depreciating it all the way down to zero, we're going to depreciate it down to $10,000. Okay. So what we want to do then is just, over 20 years now, we're not going to depreciate $100,000. We're going to depreciate $90,000. Okay, 100,000 minus 10, because we want to have $10,000 left. So the amount of depreciation expense that will be charged each year, in this case then, is going to be the $90,000 divided by 20, and that is $4,500. Okay, so when you have the salvage value, remember you subtract off the salvage value first and then depreciate what's left. Okay, now let's talk about how this affects taxes. If you sell assets, then when you sell the assets, whatever you sell it for above the book value is considered taxable. All right, and the reason is that depreciation is a taxable, as a tax deductible expense. So if as you go along and you charge that depreciation expense, you're saving yourself money on taxes. You're able to deduct that expense off your taxes. But then if you turn around and sell that machine for more than the book value, the tax authorities say, well, hey, wait a minute, you deducted all this depreciation expense, saying you're using up that amount of value of the machine and you're getting a tax break on it. And then it turns out that the machine is worth more than it should be based on the amount of depreciation expense you've taken. So if you sell a machine for more than the book value, you have to pay the difference between what you sell it for and the book value. Okay, so here's an example. So my company buys a machine for $10,000. They're going to depreciate it straight line over 5 years. So they're going to depreciate it $2,000 per year. But 2 years later, for whatever reason, I don't know, a new model comes out, I change my business, I don't know, but for whatever reason, I get rid of that machine and I sell it. And I can sell it to a competitor, let's say for $9,000. Right? Well, after 2 years, if I'm depreciating that $2,000 per year, the book value of the machine would be $6,000. Notice I've taken $4,000 in depreciation expense. I've told the tax authorities I've used up that much value of the machine. Give me a tax, I get a tax break on that amount of money. But then I turn around and sell it for $9,000. So as far as the tax authorities are concerned, I've only used up $1,000 of the machine. All right, and the extra amount there I have to pay taxes on. All right, so since the book value is $6,000, the taxable amount is the amount I sell it for less the book value. I have to pay taxes on $3,000. So if the tax rate is 30%, well, then 30% of that $3,000, I have to pay $900 in taxes. Okay, and then here is the main thing to remember here. It's really easy to get the wrong answer to the next question. The next question will say, what is your net cash from the sale? Or what is the after-tax gain from the sale? It just means how much money, how much cash you have left after you sell this machine. It's really easy to use the wrong numbers here because you went and you calculated this book value. So it's really easy to say, oh, well, 600 minus 900. Well, that's not correct. All right, you sold the machine for $900, and then this calculating the book value and stuff, that's just figuring out the taxes. It doesn't affect the amount of cash you got for selling the machine. All right, it's also easy to use this $3,000 number. Right? And because it's right there on the page, and you know you need to subtract two numbers and subtract the wrong one. But what you want to say is, how much cash do I have left from the sale? You want to say, well, let's just do, there's only two items here that dealt with cash. I put them in green, right? You sell the machine for $9,000, and then you do a lot of figuring stuff that doesn't involve cash, but you come up with a number that's taxes owed, that's $900, and that is cash. That's why I made these two numbers green, all right? And so the cash you have left then is the cash you got for selling it minus the cash you paid in taxes, and that's $8,100. Okay, notice it's important. You have to figure out the book value and all of that to calculate the taxes. But when it comes down to the actual cash you have, there's only two items. You sold it for some amount. You had to pay some amount of taxes. What's left is the cash that you got from the machine. Okay. Okay, so here's another example. It says your company is selling equipment that originally cost $20 million. That means that it went on the books at the beginning as $20 million, and this is the amount that I had depreciated to start with. Okay, 80% of the original cost has been depreciated. Okay, well that means that 20% of the original value is left, and that must be the book value. All right, if I've depreciated 80% away, then what's left is 20%, and that must be the book value. All right, you can sell the machine today for $5 million, tax rate's 40%. What's the after-tax gain on the sale? All right, so I'm going to sell it for $5 million, but I have to figure out the book value today, because if I sell it for more than the book value, I have to pay taxes on the difference. All right, well, as we said, the book value is going to be 20% of the original cost. It's $4 million in this case. I sold it for $5 million, so I have to pay taxes on the difference. So 5 million minus 4 million, obviously 1 million. If I pay 40% of that, that's 0.4 million, $400,000 in taxes that I have to pay. Okay, and then the next question is going to say, what's your after-tax gain? Meaning, what's the cash left from the sale? And again, notice it's really easy to use this $4 here and get the wrong answer. But remember, I sell it for 5 million. That's cash. Then I calculate book values and figure out taxes. Okay, and then the only cash number up here is the taxes owed. That's 0.4 million. And so the after-tax gain, the cash left over from the sale, is 4.6 million. Okay, and just to belabor the point, one more example here. After operating a machine for 4 years, you're going to sell it and replace it. So you're selling this machine for $38,000, right? You bought it 4 years ago. So the original cost of the machine was $50,000. That was 4 years ago when you bought it. It's been depreciated on a straight line basis, assuming a 5-year life. Well, you can see then that it's going to have been depreciated, depreciation expense of $10,000 per year. So the company's tax rate's 35%. What are the after-tax proceeds from selling the machine? So after you sell the machine, pay the taxes, what we have left. Again, so now I have to figure out the book value. I know I'm going to sell it for $38,000. What is the book value? Well, the original cost minus the total amount of depreciation I've taken. Well, I've kept it for 4 years, and I was depreciating it $50,000 over a 5-year life. That's $10,000 per year, so I've depreciated $40,000 of it. So the book value then has to be $10,000. All right, now the taxes that I owe, I'm selling it for $38,000. The book value is $10,000, so I'm going to owe taxes on the $28,000, so I got to pay 35% on the $28,000 taxes. That's $9,800. Notice this $9,800 is cash. Okay. Yeah. And the after-tax proceeds then are going to be the $38,000 I sold it for minus the $9,800 in taxes paid, and that's $28,200. Okay, so here's an example that you can work through on your own. I believe I have the answers noted there. So, and there's also a set of problems there that you have the answers to, so you can do those problems with more practice here.